Sponsored by Bangtak, Sustainable Business Development in Harmony with the Environment and Society. Siam Commercial Bank. And in this break, we focus on the impact from the slowdown of U.S. economy on Asia and also the clash between two presidential candidates, Obama and Romney, and their policies in helping the U.S. to revive its sluggish economy.
It relies largely on the export market in Europe and in the United States. Exports from like China or India or the ASEAN region are slowing down. You think that further monetary policy or fiscal expansion program should be adopted so that Asia as a whole, can hang on, while waiting for the recovery to take place, both in Europe and in the United States?
Yeah, it's a good question, and I think that demographic forces are positives for many of these emerging market economies, and so there's reason to believe that their growth prospects are good, irrespective of the foreign situation, the U.S. situation. I do think that, sort of like I described with the U.S., as long as we're talking about merely the direct effects of Europe slowing down on the U.S., those are probably manageable. The export elasticities are such that, as my colleague Dan Sullivan said, when somebody says, X just increased by a ton, and that's an adverse thing for the U.S., what's the effect on GDP? The answer is almost always 2% growth. It doesn't matter what the variable oil prices go up by a lot, 2% growth or something. It's minimal. The elasticities are small, but the magnification that can come from financial collateral damage or strategic complementarities, that's where we could all be in a challenging situation.
Thank you. And now I would like to invite you, members of the audience, to pose questions directly to Dr. Evans.
Well, I don't really care for the wars aspect of that question. That's the negative aspect of it. But, I would say that the U.S. does have a fairly substantial defense industry where we produce our own, for lack of a better term, weapon systems. And they do employ a large number of people. They're capital intensive, but they employ a large number of people. And given the budget cuts that were supposed to be they were supposed to be the punishment that made us abhor the idea that Congress wouldn't come to an agreement in order to solve the fiscal situation. Somehow they didn't see it that way, and so now we see these budget cuts coming. I think they're $500 million. And by estimates of the National Association of Manufacturing, those could have very substantial employment implications in the U.S. Exactly what the additional add-on effects are to the economy, I'm not exactly sure, but I think that the fiscal situation in the U.S. is such that we clearly need to address fiscal imbalances that we're facing over the medium and long term. We have entitlement programs on the books, Social Security, Medicare, which are very generous, that we have chosen not to fully fund. The state governments are in the same situation. It's always better if I have to pay a state worker, but I can't raise taxes to somehow promise a higher future payment that costs me nothing today, and some poor slob has to deal with that in the future. Well, today's the future. We're facing that in Illinois and in other states in the U.S., and the federal government has that situation too. But it's very difficult to get people's mind focused on what the implications are of these generous programs and alterations to them. So I'm not optimistic that the political process is talking very constructively about this at the moment. But I'm hopeful that once we get through whatever the electoral decision is this year, that they'll focus on that in the U.S. And if we can focus on that, it would be useful, in my opinion, to have more fiscal stimulus in the short term, at least, to reduce the negative impacts of these programs coming off, while we deal with more prudent management of these longer term issues. But it is very difficult to come up with fiscal programs where the resources get to exactly the right people, the most productive and efficient situations and cases. So it's a challenge.
This is your personal view. Do you see any differences between the economic policy of the two presidential candidates, Obama and Romney, and do any one of them create complications to defensive conduct of monetary policy?
So in the United States, in the Federal Reserve System, I've been with the Federal Reserve for 21 years. And I've been going out and speaking for maybe 15 years. And, you know, we spend a good 2 weeks of training for employees on, if you ask me a question about the value of the US dollar, I will come up with a dodge. I will not answer that question. Because that's the province of the Treasury. If you ask me about the political campaign, I think the same training that I got with respect to the dollar carries over here. You know, we're all hoping that there's thoughtful, constructive dialogue during the campaign, that the American people, you know, give their choices clearly to not only the presidential election, but also Congress and the Senate, so that we end up with sensible improvements in our situation. But it's been challenging.
Any questions?
Financial literacy is unbelievably important. We would get better political discussions if everyone had enough financial education and understood the terms of the debate and the various policy alternatives that were being offered, to be able to sort through what is sort of dodging a difficult issue, but is actually laying out a possibility. We would be much better off. We have many programs in the Federal Reserve and at other institutions, private sector institutions as well, geared towards helping inform the public about the best way to manage their money, to understand finances, to understand interest rates, yield to maturity, how to invest. No, they can't give investment advice and things like that. In Chicago, we're very proud of our Money Smart program that we've been doing for over 10 years. And rather than recreate the wheel and develop our own programs, we partner with private institutions, banks and other financial institutions who all have a vested interest in having an informed consumer and small business entrepreneur to help them make those decisions. I don't know, I haven't studied this carefully enough, but every time I've seen special studies about challenging financial decisions that even very educated people make, it's not comforting. The evidence seems to be that, you know, I've got a PhD in economics, and yet, the first time I took out a mortgage, I let some runt kid from a local college in South Carolina talk me.
School in South Carolina.
I was on the faculty at the University of South Carolina. He talked me into being concerned about my approval on my mortgage, and if I paid down the interest rate, if I bought it down for the first year, that was the only year that they actually made a comparison to servicing to income, I'd have a better chance. Net present value, this was a loser, but I did it. Now, if you do those decisions over and over again, you get good at them. But there are a lot of decisions you don't do over and over again. And that is a devastating critique if you really internalize it. So there's a lot more that can be done, but we really need highly informed and educated citizens of our countries who can navigate those things. It's difficult. And you know, my own experience as a trained economist is to sort of, you know, back in 2005, I was on the board of a nonprofit institution in Chicago, and it was composed of a lot of people who had wonderful intentions for helping low and moderate income individuals in the metropolitan Chicago area. And this was an organization that had been chartered initially by the civic leaders, the CEOs in Chicago. But at one of the meetings, one of them showed me a map of Chicago and the subprime borrowing by neighborhood. And and by how delinquent they were. 2005 is my memory of this, and red was really bad. The south side of Chicago was deep red, the west side was deep red, and there were a lot of other areas that weren't very good either. And what the person in a very pointed manner said to me was, "Don't you think this is a travesty? Don't you think this is a horrible thing for these people?" And with my training, I sort of said, "Well, I know what you mean. Of course, if the financial literacy issue had been taken care of, then they knew what they were getting into, and all of a sudden they had access to credit, which previously they didn't have access to." So I said, "I look at this and I see a good thing." I think I was wrong on that one. I don't think that worked out very well. I think that in Chicago there were some pilot projects which we tried to the state legislature mandated that certain individuals in certain zip codes of Chicago, if they undertook a particular mortgage application, had to submit to counseling. And this is dicey, right? Because it's basically identifying areas where you're, parochially saying they might not know enough on this. So it's very divisive. Our research staff studied that, and they found that this program was actually somewhat effective. And every time the terms of the mortgage offering were changed, you had to submit to another brief counseling session. So it was very onerous from the financial institution standpoint. And it wasn't that the borrower found out that this was a bad deal and withdrew from it, but it was the light that was shining on these activities that made the financial institutions withdraw from selling those products. It doesn't matter how it works. It still ended up that it was probably a better credit allocation mechanism, but I thought that was enlightening in terms of how that works. I think the subprime mortgage issue is very challenging to think about. I sympathize with Chairman Bernanke, who came to our Bank Structure Conference in early 2007, and he said, well, subprime, they're looking at pretty big losses, $40 billion in the industry, but they seem like they're manageable. They seem like they're capped. And when you think about this as a contained loss that's not systemic, that wasn't going to have the collateral damage with everything else, I thought that that was probably a fair estimate. But when you understood later that there was all this securitization, I'm sympathetic to the analysis that Gary Gordon has done, which indicated that financial institutions wanted safe assets that did not require continuous monitoring, and the securitized tranches of that satisfied that, and so they went into that in a big way, but of course the ratings on that were overly glowing and optimistic. So I think there were a lot of things at work, and it would be nice if we could improve credit access for people who are challenged, but it's got to be prudent access.
And that wraps up towards 2015 today's edition. See you again, same time, same place, same channel. And on our next break, meet with Kun Vinarat Rauhapakukun and her viewpoint, all the views, all the points in ASEAN region with ASEAN and regional global key figures.